Good morning. I'm Greg McKenna, and welcome to the 13th of October's market wrap. Wasn't the most exciting of nights overnight with the US market open, but the rest of the country on holidays for Columbus Day. But stocks in Europe were a little bit disappointed with the lack of follow-through that we're seeing in the US. Certainly, US stocks managed to finish in the black, but overall, they're struggling to go on with this momentum at the moment. And Jim Paulson, who's the Chief Investment Officer at Wells Fargo, a bloke that I follow quite a bit, just reckons this is profit taking. Now, of course, all of this is consistent, and I should stop banging the screen. All of this is consistent with what we've seen in markets since the crash in August. We have seen the crash, we've seen the snapback, we've seen the consolidation, we've seen the move higher. So now what we're looking for is the catalyst for the next move. Markets in many ways are in a status quo kind of environment. Last night we heard from Fed speakers saying, and Lockhart in particular, saying that market's not in sync with the Fed, and that implying that a December hike is still possible. But he added that rates aren't going to go too high. And I think that's the message the Fed is trying to get out and has been trying to get out for a while. Yes, they want to raise rates because they don't want to be caught with rates at zero if the US economy slows at some point in the future. But they're not going to raise rates that aggressively. So we're at this kind of conundrum. Obviously, the data has to support that, and non-farm payrolls in a couple of weeks' time will be the next chance that the markets get to see that. But for the moment, we're just going ebbing and flowing on what people are thinking. So the next big catalyst has to be earnings season. And while there wasn't a lot of earnings out last night, tonight we kick off, and by the end of this week, we'll have a better feel for what's going on. Of course, earnings season takes quite a few weeks. But for the moment, that's the catalyst we need. Earnings season is either going to be positive with upgrades, flat, or negative. There's those three options. Can't really be anything else. I have no idea. The US dollar's got a little bit weaker over the last month or two. Is that going to flow through? How's the economy going? There's been a lot of cars purchased. If there's a lot of people in jobs and a lot of cars purchased, then that suggests that the underlying economic momentum, perhaps not as measured by GDP, but in terms of what corporate America is seeing, is going to be okay. Now, of course, you've also got issues with the impact of the slowdown offshore and what that's going to happen. So there's a lot in the mix. But for the moment, markets are struggling a little bit to know what to do next. Oil, however, wasn't struggling. Last night, we saw that the price of crude, having rejected the previous day, the 200-day moving average, which it hasn't been above since for July 2014, I think, if I'm correct. And yesterday, I think we said, I certainly wrote, that oil is probably going to drop down towards the 47s. We saw that last night. The reason I say it was dropping down to the 47s was we saw a rejection of this big, important 200-day moving average. The 200-day moving average is the moving average that a lot of traders use as their delineation between a bull and a bear market. So it's natural that when a market approaches a 200-day moving average from the bottom side, that there are sellers there waiting to sell. In the same way that it's natural that if a market approaches a 200-day moving average from the top side, that you're going to see buyers. So what we saw was this nice, easy, perfect move, exactly what I thought would happen, down to my fast moving average. Why does that happen? I've just found over many years of using this system that markets often retrace in the first instance to my fast moving average when my system sets up the way that it did for oil yesterday. Where to now? That's a more difficult question. I'm square, but it could go another dollar or so. We'll have to wait and see. Elsewhere in markets, the ASX 200 has popped back a little bit. And yesterday, of course, we saw the ASX fall 0.89%. It was across the board selling. We've seen oil down last night. Copper held in well. And some of the some of the base metal complex was down. Some of the base metal complex was up. Iron ore in Dalian terms fell a little bit. So my expectation is we will see the Aussie market fall back a little And I wouldn't be surprised to see it back down here at this 51.60-ish, maybe 51.60, 51.80 region at some point in the next day or two. As traders, having naturally found a top around these levels, are looking for some support. Excuse me, getting emails in the middle of this talk. There's a chart. A big one to watch is, of course, the S&P 500. It's a massive week this week. It really is a massive week. You know, I've got all these earnings reports. What are we going to do? We've got a massive uptrend line that was breached recently with a crash down towards the same sort of lows we saw in 2014. You know, while I think it's in a topping pattern, and I've said consistently that means that it could still pop up, and it's popped up a bit. You know, where's it going to go? I doubt that it's going to break. That it's going to have the momentum to break back inside that old trend line. So 2050 is the level that I'd see as the peak. Because look at this trend. You know, we had the bottom from 2009 back in March. That then became the top of the next leg of the rally. Phenomenal, these you know, these two trend lines. Now, you don't have to be a chartist. I know not everybody who watches this will be a chartist. Think about it in behavioral terms. People who are trading need some signposts. Where do you get those signposts? Well, you can look at fundamental valuations, but fundamental valuations are much easier in the context of individual stocks than they are of an index. And I think, and I strongly believe, that it's simply the case that even if you're not a chartist, you should look at charts because you know what other people will be looking at. It's exactly what Keynes talked about when he explained in terms of the beauty contest and how that beauty contest is works out. So it's not necessarily, if you're trying to pick who the winner of a beauty contest is, you're not picking who the prettiest or the most handsome, it could be blokes, person is. What you are doing is you are trying to pick who the other people think is the best looking or the most handsome. You could then get a second and third and fourth and fifth derivatives where you're trying to second guess what they think you'll think, and what you'll think they'll think you'll think they'll think. And so it goes on. So it's not really about the market per se. It's about what other people are thinking and other people are doing. That's why 20 odd years ago, when I first learnt about Daniel Kahneman and Amos Tversky, and behavioral finance, I embraced it with such gusto, and I definitely call myself a behavioral finance and behavioral economics guy these days. Speaking of which, that means sentiment's really important. We've got trade data out in China today. That is the big event risk for markets globally in the next 24 hours. Further contraction in exports, further contraction in imports would be a bad sign for the recovery in risk assets, and a bad sign for stocks, the Aussie dollar, those sorts of things. So keep an eye out of that. Obviously, the opposite's also true as well. But before we get that, at 11:30 today, we get the NAB business survey. And my colleague David Scutt's got a great 10-second preview over at Business Insider that I'd suggest you have a look at. But overall, this is, for me, the most important economic release that we get each month in Australia. Of course, most of the focus is on labour force that we get on Thursday, and once a quarter it's on GDP. But the NAB business survey, for me, captures what businesses are thinking. And that's important because the conditions part, confidence is always important because confidence drives investment, confidence drives hiring. But the conditions part tells us what's actually going on in the real economy. And even for a business that is not overly confident or not looking to employ a lot of people, if that business is doing well, then that feeds back into the attitudes that managers in that business have, then that feeds into their interactions with staff. And ultimately, in a service-based economy like Australia, it's about the staff, because the staff are businesses' customers. That's why I think the business survey is so important. So watch that 11:30 today. But overall, we've got markets in a state of flux, waiting for the next shoe to drop. Looks to me like euro at 113.96 last night might have made a short-term peak back towards that 112.70, 113 big, round kind of level. ASX looks to me like it's coming down. I've exited longs on the Aussie because I think it's close to the peak, the 74 level. for me was the region from the 1 year downtrend, and it made a high last night of 82. I was out yesterday afternoon anyway, so I missed 30 or 40 points of this one. A bit silly, but it is what it is. So that's it for me today. It's another interesting day in trade. Chinese trade's the big one, and we'll see what happens there. Oil's crashed, entirely predictable. Where to now? Keep an eye on that. And also, as I've been saying, watch dollar sing. It's the developed markets, emerging market, and I know the MAS and many of my Singaporean friends won't like me saying that, but I don't mean it in a derogatory term. It is open to global trade. It is working with many of these countries as it goes through the Singaporean hub. It's a nice developed microcosm of what's happening in emerging markets. On that front, in my 20 seconds report at Business Insider today, I covered off on a piece by Sam Rowe about what's going on in the junk bond market. Interest rates markets and bond markets are normally where market ructions start. Just think subprime, and you've got the GFC. Think of the bond blow up in 1998, and you've got 1994, and you've got that. Think of what happened with emerging markets in the late 90s. Think of the LTCM crash. All of these were interest rate or bond related. And in many ways, I think 1987 was too, but that's a whole other story. So keep an eye on what's going on in emerging and junk bond markets. That's it for me today. Have a great day. I'm Greg McKenna. You can catch me on Twitter at Gregory McKenna. You can always catch me at Business Insider. You can catch me at my own website, gregmckenna.com.au. Have a great day, everyone. Bye for now.